At the same time, the United States is entering what's known as the Great Wealth Transfer. Over the next 20 years, an estimated $120 trillion is expected to change hands. This is happening because baby boomers currently own just over half of all wealth in the country, and as they age, those assets will be passed down to children, grandchildren, charities, and other beneficiaries. As this wealth moves from one generation to the next, it's going to change how money flows through the economy. We're already seeing more than $1 trillion per year changing hands, and that number is expected to accelerate. The real question is how this shift will affect spending, investing, and long-term economic trends. One of the first things to understand is that younger generations spend money very differently than baby boomers. Millennials, Gen Z, and even Gen X don't approach money the same way their parents and grandparents did. This matters both from a spending perspective and an investment perspective. On the spending side, there's an old concept sometimes referred to as the third generation problem. The idea is that one generation builds wealth, the next maintains it, and the third often spends it. This doesn't happen in every family, but it's common enough to matter at a macro level. When people receive money they didn't have to earn, they're statistically more likely to spend it. That's why the most expensive kind of money is often free money. As inheritance transfers accelerate, increased spending is a likely outcome. That spending alone can have a meaningful impact on economic growth. Another factor is the type of assets being passed down, especially housing. In the U.S., homes are often viewed as the cornerstone of generational wealth. But inheriting a home doesn't always mean inheriting financial freedom. As home values rise, so do property taxes, insurance costs, and maintenance expenses. In many cases, heirs may find that they can't afford to hold on to the property, which can lead to increased selling and further changes in spending behavior. Now, when we shift from spending to investing, the generational differences become even more pronounced. Baby boomers largely followed traditional investment strategies centered around stocks and bonds. Younger generations tend to diversify differently. Instead of bonds, they may allocate toward crypto, gold, private equity, startups, or alternative assets. This matters because asset prices are driven by supply and demand. When more money flows into an asset, prices tend to rise. When money flows out, prices tend to fall. As wealth moves from older generations to younger ones, investment capital is likely to spread across a wider range of asset classes, many of which historically haven't received as much capital from previous generations. From an economic standpoint, the biggest takeaway is this. When people spend more money, the primary beneficiaries are asset owners. If someone spends more at companies like Apple, Amazon, or Chipotle, it's not the employees who benefit most. It's the shareholders. That's how the system is designed. Inflation reinforces this effect. As prices rise, the value of assets tends to increase, which again benefits investors more than wage earners. On top of that, the tax code favors investment income over earned income, and corporate leadership is legally obligated to act in the best interest of shareholders, not employees. All of this means that as the great wealth transfer accelerates and as more money is passed on tax-free, the long-term advantage continues to tilt toward investors. That doesn't mean markets will only go up. Recessions and market crashes are a normal part of the economic cycle. Over the last century, the U.S. has averaged more than one recession per decade and multiple major market corrections. These periods are uncomfortable, but they're also when long-term opportunities are created. When panic sets in, people sell. When prices fall, assets go on sale. The investors who benefit are the ones who understand cycles, manage risk, and have the discipline to act when others are emotional. Even if you never receive a large inheritance, you can still benefit from this shift by understanding how money moves through the economy. Trillions of dollars will change hands over the coming decades, and a significant portion of that money will be spent. Historically, the people who benefit most from that spending are those who own assets. That's why understanding these dynamics matters. Not to predict markets perfectly, but to understand the system you're operating in and how wealth is actually created and transferred over time.